Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, it's time for a weekly update of the SPY, and we're going to also stop and have a look at the put to call ratio and the VIX. I'm going to try and get this over with as quickly as I can today. I'm full of cold at the moment, unfortunately, and my voice, having completely broken down in last week's live stream, is right on the edge at the moment, so I'm just going to try and get as much work done in as small a time as possible. So I wanted to start with the classical analysis first today before we come in and have a look at the Elliott wave, because last week's close was a pretty significant close for the SPY and shows some pretty convincing strength of the prior which began from the prior week of the 10th of October into last week, where we basically closed above the last 3 weeks candles closes, so potential sign of a reversal here. Now whether it's temporary or whether it's a low, only time's going to tell on that. But if we look at where we've come to the 50% retracement of this rally from the March 2020 low. So if I actually just need to drag that fib level down, and you can see that it's basically to the tick at the 50. So we've given back half of everything the market gained from a March 20 low. Pretty significant. I think that puts us, I can't remember exactly what the total decline from the high was. Let's just have a quick look. Officially went into a bear market of 27.47%. And we've come straight to this green line here, which is the 250 weekly exponential average. So we found support here at the 50, at the 250, at the 50 fib and the 250 exponential moving average. We can see how we were just coming into this little area of demand here, which you can see is these prior pullbacks, where we came down, found buyers, came down, found buyers and moved on. We've got, if we look at our fixed range volume profile, which was most recently, we can see that our point of control is right in this space as well. We've got this increased volume in here. There's other areas further down, which if we zoom out and have a look at, the next significant point of control on our visible range profile here, we can see straight in this demand zone here where we've had prior pullbacks and buying as well prior to the March 20 collapse. That's below the golden ratio, down into the 78.6 and the 89% retracement of this move. So we could still definitely go deeper. We've got some significant support levels around here as well: 338, 323, 294, all down here, all structural support waiting for us in amongst all of this volume, in amongst these fib levels. However, I think for the meantime, just illustrating there that we have got considerations of going lower, so I'm totally open to the idea. However, I do feel that there's a strong possibility of a rally from here. Having come back to the 50, come back to the 250, got a strong move off of the low. Now it might be a bear market rally before we roll over again, but coming to the 250 after the 10 and the 20 cross through the 60, we can pierce this and come lower, just like we did in March 2020. We dragged the 10 and the 20 through the 60, came through the 250 and then rallied. Here we dragged the 10 and the 20 through the 60 to the 250 and then rallied but did not break it. And we can see we did it back here as well during August 2015 and January 2016, and we also did it here during 2011. This was the fear of a double dip recession, and we were still below the 250 here in late 2010. So we've come back to a major level and we've bounced essentially. Now if we look at our indicators for a moment, we can see how on the MACD we've had significant divergence of higher lows while the market has produced lower lows, so bullish divergence underlying this. If we look at the RSI, we can see the same. We've got a series of higher lows while the market set lower lows, so we're quite bullish in terms of bullish underlying pressure here. Now when you think about sentiment at the moment, I think it's about as bearish as it's been for a long time. I've been seeing, being a YouTuber obviously, I get it inundated with videos on my homepage all the time, and I get the impression that there's a constant chatter of 50% drop from here, 30% drop, 20% drop, whatever. Market's going to implode on Monday. Now that could happen, but whether it's just my contrarian nature, I've got a feeling that we could well be in for a rally, at least for the short term. What it turns into will become clearer if it unfolds, and we can look into it to see if it's a clear 5-wave structure. And then if we do get a clear 5-wave structure off of this low and the 3-wave move back, I think that's a very strong potential buying opportunity with a pretty safe setup off the back of it as well, with a pretty clear structural stop for that trade. So that's essentially the way I see things from a classical analysis point of view for the moment. I just want to touch on a couple of other things when I come down to the day time frame. Don't need our moving averages here, we're well below the 250 on the day time frame. We can see how the divergence which is present on the weekly time frame. Now there's an argument, you're going to have some people say that you need higher lows to have divergence. I would argue that if lows remain level, at the same level in momentum, and yet continue lower, that's still the definition of divergence. One's doing one thing, one's doing the other. So that's still divergence in momentum there. We can see we've still got this clear downward trend in the OBV. If we are putting in a low here, I would like to see bullish accumulation of volume and a break of this downward trend in the OBV, right, and start trend higher with some bullish weeks behind us. I would also like to see a new high in the MACD as well. I'd also like to see a return to overbought conditions in the RSI. If I see all of those things in the coming weeks, I'm going to become, depending on what kind of rally we get out of here structurally, I'm going to become more confident that we have put in a sustainable low. Now I know it's probably not what a lot of people believe or can believe or want to hear at the moment, because everyone is very bearish, but the market can only bottom. The market can only find its absolute low at the absolute low of people's psychology, can't it? It won't top out when everyone's bearish. It will bottom out when everyone's bearish. It will top out when everyone's bullish. So I'm open to the idea of it going lower, but we've got a potential rally on our hands here. We have to see how it unfolds, and I think we are obligated to give it the benefit of a doubt. So on that note, let's have one quick look at the shorter term time frame here, where there is clearer divergence on the day time frame. So we've got lows into this strong bullish candle here, and we've got quite clearly divergence on the OBV, divergence on the MACD, and divergence on the RSI, all on the daily time frame over the shorter term, signaling this being a potential reversal. Reversal, it could be temporary, it could be long term, it could result in a big rally, it could be momentary before we roll over, but I'm looking at it and thinking it looks pretty strong. You know, looking at the two bullish candles we've had over the last week, we had the 13th of October, which had a good push from volume here, we can see, and we can see that the Friday close had a good push from volume as well, whereas the more bearish candles in between were all with lower volume, more likely corrective price action of a bullish trend rather than aggressive bearish action of a downward trend. So two strong pushes for these bullish candles supported by volume. I would like to have seen this a little stronger, but I honestly feel it was a lack of time. We just didn't have the time left in the week on the Friday to get any more trading done. I think if the next part of the rally had begun on the Thursday, we would have probably seen an even stronger close for the week. So in the meantime, I would very much like to see the prior pivot here get taken out. This is 379 spot 46, so this is going to be local resistance. In the meantime, we can see how obviously it's also supported by with prior structural resistance back here. We've got this pretty significant low back on the 23rd of May. Travelling forward in time, that's very much basically the same area as this high here, so looking for resistance in the short term here. If we get through this and continue to impulse higher, that's a positive sign that we've picked up some bullish momentum and are likely to continue a rally, so we can at least look at that. Now let's just put this into that's long-term local support and resistance, and lock it down. check that I haven't just duplicated the level. Price support here, this could be resistance now as well. We can see this was a support level, so we should change this over to resistance as well. Highs here, lows here, highs here, highs here, lows here, lows here. Very strong level of resistance here at 390. We'd like to see that broken as well. Then we've got the highs here at 417.44. After that, we've got the highs on the 16th of August. We take out those, and we've got an impulse off of the low. I think at that point, you've got to be looking for a retracement as a buyer, really, because we would have broken out of this downward negative volume trend. We would have set new highs in MACD and in the RSI. We'll be looking a lot stronger. So still a lot to come, still a lot of work to go through before we get there. So anyway, that's the conclusion of the classical analysis for the meantime. So let's look at the potential interpretations for the counts. Okay, so primary is still bearish. Now this may change because, like I said, if I'm giving it the benefit of the doubt that this is a low, if we come roaring out of here, I have other counts I can consider. But for the meantime, sticking with the idea that things can always get worse, my primary essentially says that we've got a series of expanding zigzags. So each time we get a correction, the next move is more volatile than the prior one. So we've got this initial little zigzag, which could have easily been part of a continued uptrend, right? Then we had a much more convincing breakdown here, and we're going to finally get an even nastier one here. It basically symbolises the market coming to terms with a new reality, which is the Fed's going to pivot. The Fed's going to pivot. Oh my god, the Fed's not pivoting. And it's basically that kind of psychology that each zigzag is more aggressive, pushing price lower than the prior one, and we end up with this triple zigzag. Okay, now there is a more bearish one as well. Since we're talking bearish, we might as well look at that, which is the idea that all of it, the two would be well off, well off. All of this is an expanding leading diagonal, and we've gone 1, 2, 3, 4, and now we've just gone A, B, C to get 5, and then you'll get a much more significant rally in the B, and then you'll head lower in the C. Now that's very, very bearish. Biggest problem I have with this is the inability to get the motive structures, such as the A wave here, to break down as 5 waves. I prefer to see this as a 5, 3, 5 to here, as I can get it on a smaller wave degree to subdivide as 5, 3, 5. When I try to look at this to this pivot, I can only see 3 waves. I know I've said this lots of times. I feel this breaks down as a zigzag quite nicely, so that's okay. And I feel with 5 waves here now, that breaks down as an A wave, so that's fine. With this, just this initial thing here is why I prefer to look at it as a separate zigzag rather than as 5 waves in an A. Okay, but that's a possibility as well. So that's going lower. We've got our lower levels to think about. But what if we have bottomed here? How have we likely done it? Well, we have a bullish count here, and this is the idea that we're done. The wave 2 is already in. Like I said, my voice, excuse me, I can feel my throat tightening up as I speak to you, so I better hurry up. We have A, B, C into W. This is our first little zigzag, which could have been part of a prior trend. Then we had a correction. Then we had a break of that, a clear break of that prior trend. This is a bit more panic, a bit more concern, a little bit more loss of confidence, then a correction, and then we've had another zigzag pushing price lower, this being a double zigzag, breaking down as ABCW zigzag, X, ABC, Y of Z to get the 2. And now the market's bottomed, coming back to that 50% retracement to the tick. Okay, so if we now see an impulse from here, clear 5 wave up and 3 wave back, we know we're talking at that point about either a 3 wave move, okay, before continuing lower. Now that 3 wave move could take price to new highs, okay, and the whole structure could be a flat. Now we're not going to know that. We're not going to know that for some time, but you can easily make new highs from here and still have a much longer term bearish count. That's just how things are when we're correcting at larger wave degrees, and we've got so much uncertainty out there on the macro scene at the moment about what's going to happen and when. But if it's not free, and we come up in 5 here and back in 3, then that 3 wave move could be 3 into 4 into 5 on a larger time frame. Now if you see 5 out of here to a new high, it's not corrective, it's not part of a larger structure. The market bottomed here. Alright, so at that point, I know this is months out potentially, any 3 wave move back is a buying opportunity to go higher at that point. 3 waves on its own as 5, 3, 5, bump, 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 could be a B wave of a flat at 90% retracement or more, and then down 5 waves in a C for a larger ABC. We're going to have to worry about all of that later. In the meantime, trading on the shorter term time frame, if you get an impulse out of here and a 3 wave move back, I'd be a buyer to move higher, stop here. Or even take a smaller pivot using my STS here and take a pot, stop here and limit your risk further and trade it out like that, as and when you see that move. Right, so that's how the market could have bottomed down here. So I don't think there's really any point going into anything else for the meantime on the Elliott wave scene until we see these levels we spoke about on the shorter term time frame actually getting taken out. If these all get smashed and we take out this major X wave pivot here and we've got 5 waves up, I think you'd be a bit foolish not to be bullish at that point. Honestly, because all the odds are on your side, momentum's with you, you're just looking for a pullback to enter, you can set the trade up safely. I do find it very irritating when the bulls, all bears, start calling each other out by saying, oh, if you do that you get wrecked. Why would you get wrecked? Manage risk, for God's sake. You don't have to take any more risk than necessary. Alright, so if you see an opportunity like that, yes, it could be 3 waves up to correct lower, but odds on, if you break all that resistance, especially if you make a new high on strong momentum, there's a strong possibility the market bottom down here. So too early to tell at the moment. Yes, the primary is still bearish, looking for a 3 wave correction in the B. But if we take out this X wave high, then any short term correction is incorrect and this count is wrong. So there you go. That's the Elliott wave count. Give it the benefit of the doubt in the meantime, I would say. So let's move on and have a quick look at the PCC and the VIX, and then we'll wrap things up. Right, so over here on the PCC, I've got the extreme reading for the PCC occurring on the 21st of June 2022. Now, I've gone back, as you can see, with these prior peaks, and I've compared them to the lows in the markets. Sometimes they're within a few days, sometimes they're in advance, sometimes they're lagging. It's not a certainty, but they always occur at or around the lows, and always have done on all of these prior highs, such as the 6th of April 2020. Right, the market had already bottomed into the March lows by that point, but that's when we got the high on the PCC. We got the Fed pivot, the Powell pivot of December 18 on Monday the 24th of December. This was Christmas Eve. We know the market bottomed on Boxing Day. Okay, 4th of April 2018. This is a little taper tantrum at the start of that year. Then we've got October 2011 and February 2010. So sometimes we get in early, sometimes we come in a little bit behind. But the most extreme reading we've had recently was the 21st of June. So if we just come back over to the SPY, bring up our PCC extremes here, we can see here's the reading we had on the PCC. On the weekly time frame, we've made another low with divergence, bullish divergence on another low. That strikes me as quite early, June to October. Okay, so that's probably more of a feather in the cap of the bears at the meantime, but we haven't made another extreme yet. So perhaps we had a high and a lower high diverging with a low and a lower low from essentially the premium here on put the call and the actual price action of the SPY. So it could be that we've gone 2 lower highs double topping and 2 lower lows essentially double bottoming, not to the same level obviously, but you see what I'm saying. There's potential divergence between fear, okay, and price action. So it's all about how you look at it. So I'm still going to leave that as the extreme, as that is the actual extreme, and there's always the possibility of the PCC moving higher to a new extreme, at which point I will mark it on the chart if we get new lows. Alright then, so finally, it's kind of pointless doing this, it's just out of habit really. Let's have a look at the VIX. So the VIX refuses to get excited. Now, I've been chatting about this with a few people I know, and we've been talking about perhaps all of the cock-ups which have occurred in recent years, whether it's, you know, the repo market in 2018-19, you know, fragility in bond markets and other sectors. The Fed may now have so many tools at its disposal that it's able to backstop a lot of the panicky or more risky sectors of the markets while still maintaining its push in monetary policy. So maybe the VIX is just suppressed because nothing's breaking, and maybe nothing's going to break. I know a lot of people are screaming for things to break, but there's no sign of it yet. I mean, the UK's had an incident, obviously, here in my country, but the fact that we've had an incident over here actually makes it less likely anything's going to occur in the States, because everyone's going to be on guard now and keeping an eye out for every possible crack, which makes higher vigilance, means things will get spotted earlier, which means things will get backstopped on the QT, right? And they probably won't break. So there hasn't been an event, and the lack of an event is why the VIX is still suppressed. All of these things came with significant emotional events, okay, which put risk premiums up a lot higher, and essentially marked lows. We don't have that same green line for the VIX. Is missing. We've got the PCC extreme reading, but not the VIX extreme reading. Maybe it's coming. Maybe we're going to have that final push lower. I would be happier if we had it, and then I could say, yeah, we had a huge spike in the VIX. We had a huge spike in the PCC. We got tops here, tops here. That was the bottom in the market. I can't be as confident as I could have been in either of these. I mean, the extreme reading in the VIX during the COVID crash was one of the clearest signs of a low we've ever had. Other clues would be markets going to zero, like oil, like the WTI. That's a once in a lifetime kind of buying opportunity. We haven't had something as obvious this time. The market sold off in a pretty orderly fashion. Maybe that's because the Fed's in a better position to backstop things than it's ever been. Perhaps, just theorising. So, either way, let's sum up quickly then. The market could still head lower. Okay, and look out for a final zigzag down, and this could be 5 waves A, B and C. We could have some catastrophic stuff on our hands. If that same zigzag plays out, this could be a diagonal. Alternatively, we've already bottomed, and we're going to get a nice strong rally out of here, and it will probably be quite hated if this happens. There'll be a lot of bears out there screaming bear market rally, and it's often the case that not until you get to new highs are they willing to throw in the towel, and by then shorts have been covering all the way from down here. Fund managers have had to allocate because they've got all this cash sat on their books, and then by the time you get to new highs, retail's pouring back in, and we're off. We are running at that point. So all of that could still happen. So there you go, guys. I'm going to leave it there. Thank you very much for joining me on this technical analysis of the SPY, the PCC and the VIX. Relatively short and sweet this week. Huge thank you to my Patreon subscribers. Your support is greatly appreciated. If you're new to the channel and you like what you're seeing, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. Feel free to leave us a comment in the comment section below, and if you are interested in joining the Patreon and getting access to weekly live streams and a public Discord, exclusive videos, a whole raft of stuff, including all of my educational content on Elliott wave and classical analysis, there's a link to the Patreon in the description box below. Head over, have a read of the tiers, and if you're interested, feel free to sign up, but I would suggest that you wait until the start of November now, as there's only a few days left in October, so you get a 4 month's value. Alright then, guys, take care of yourselves, and I'll be back with you hopefully soon. All the best. Bye bye.